Now, a lot of people, households, consumers and investors alike are watching these numbers very closely. 7.5%, it's much higher than many had expected and causing some concern. What is your reaction to today's print?
Of course, this is a very high number. Behind the overall inflation rate is a 45% increase in energy inflation between this year and a year ago. And that's a very large, yet another large step increase from the 32% we had last year. So clearly, here we are, at the 1st of April. The war in Ukraine has added a further upward pressure, as you just said, to energy prices, to commodity prices. So this, to ask the European economy to absorb a 45% increase in energy prices, which in turn is of the scale that it's pushing up costs across the economy. So all of the different sectors behind the overall number are seeing an increase in prices. This has many consequences. So as you said in the introduction, households will be suffering in terms of their purchasing power. Firms face very large energy bills, especially in the most intensive energy sectors. Governments are also, of course, responding in many ways to this energy shock. So what we have to do as the ECB is to analyse the consequences of these very high inflation numbers, which operate through a number of channels. Of course, through inflation dynamics. With these high numbers, there will be more momentum behind inflation through second round effects and so on. But we also have to look at the implications for the supply capacity of the European economy. Many firms will struggle with these high energy prices and for demand. And then maybe the other point to note here is the war has many consequences for Europe. We've also seen in recent weeks a big dip in some sentiment indicators. So in our upcoming meetings, we will be putting together the kind of first order impact of these very high energy numbers, but also the implications for confidence, for real incomes, for supply. So it's, of course, a very major development for us.
Philip, it's Annette here in Frankfurt. Let me ask you about, you have been referring already to second round effects, especially the wage development. Are you seeing signs that this is picking up faster than you previously expected, and what also could mean a change in your assessment?
So what I think we are seeing is, I think it takes time for the wage response for the wage response to the price increases. So I think early this year we are seeing some signs, but very mild, of wage responses to what's happened so far. But of course, for those who were negotiating wages maybe in January and in February, that was before these high inflation rates have picked up yet again. So what I would say is, in terms of what's been concluded so far, it remains the case. We see wages only responding in a very limited way. But of course, we have to take into account, and by the way, in our projections, we do assume wages will grow more quickly over the course of this year and into next year. So I suppose really what I'm saying, Annette, is that this is, of course, on its own terms, something that will raise the cost of living, will reduce purchasing power, and will be surely a factor in wage negotiations to come. On the other hand, the ability of firms to pay higher wages will have to take into account the fact that firms face higher costs also. And then we have the wider demand environment where the loss of real income from paying these high energy prices will reduce demand. And on top of that, we have the war situation where the uncertainty of the war also creates uncertain demand conditions. So it's, if you like, a situation where many things are going on. I would summarize it as a situation for uncertainty. And of course, this is why in our March decision, we emphasized optionality and flexibility in monetary policy, because we have to realise under these situations that the kind of a correct monetary policy response will depend on how the data arrive in the coming weeks and months.
Some commentators are suggesting that you're facing a policy dilemma right now, because clearly growth estimates are getting downgraded really fast. We've just seen it for Germany this week, with growth projected now at 1.8%, potentially a recession in the second quarter. So how much of a headache is that for your policy projections?
So, of course, with this type of a supply shock, essentially, and the uncertainty shock, you do have that difficult situation. But in the end, I mean, this is why, when we, especially in our quarterly meetings, when we have comprehensive assessments, comprehensive new forecasts, essentially, these have to be brought together in forming our medium-term inflation outlook. And what we concluded at the March meeting is essentially, if the medium-term inflation outlook remains in a situation where we think inflation will not be falling below our target in the medium term. And over the next couple of years, as you know, that the forecast for 2024 was a little bit below at 1.9. In terms of our sequence, the first decision will be, if the medium-term inflation outlook is maintained, that we will be looking to end net purchases in the third quarter. However, if the outlook deteriorates by so much that the inflation outlook weakens, then we will have to think again. And what we have here is we have opposing forces. We have the energy shock, the prospect of second round effects, pushing up inflation. On the other hand, as you say, the weakening of sentiment, the fact that real incomes will suffer with the high energy prices, especially over a kind of a 1 or 2 year horizon, will have a negative pressure on the inflation outlook. This will be, why it's going to be a lot of work, a lot of analysis, a lot of debate about the net impact of those opposing forces. So today, this is again highlighting the impact of the war, highlighting really levels we have not seen, and but to properly assess this, to take it side by side with the news about sentiment. But by the way, yet another complication is that we also have the reopening of the European economy. There's still a momentum compared to last year in terms of the normalization of economic activity, that I think it's important that we take our time, use the upcoming meetings, use the forecasting exercises to bring all of that together and form a net assessment in our upcoming meetings.